In 2025, the U.S. aviation landscape is undergoing a dramatic but quiet transformation. The signs are not found in headlines or breaking news alerts, but in empty terminals, canceled routes, and silent gates at airports once bustling with international travelers. The numbers tell a stark story. The global airline industry is projected to lose $84 billion this year, with losses expected to top $100 billion by next year. Yet behind these figures lies a more localized crisis. International carriers are steadily withdrawing from the U.S. market. We'd love to hear your thoughts on this unfolding situation. Have you noticed changes at your local airport? Have recent travel plans been affected by route cancellations or price hikes? Share your experience in the comments below and join the discussion on how this shift is impacting communities nationwide. Iceland's Play Airlines was among the first to make a decisive move. After years of investing in U.S. routes connecting cities like Boston, Baltimore, and Stewart International Airport in New York, Play Airlines abruptly ceased all U.S. operations in 2025. These routes weren't temporary experiments. They were part of long-term growth strategies aimed at tapping into what was once the world's most profitable aviation market. The exit was swift and final, with no promises of return. Air Canada followed with deeper cuts. The airline eliminated 5 major cross-border routes and suspended operations at 8 regional U.S. airports. Among the affected cities were Detroit, Indianapolis, Minneapolis, Nashville, and Tampa nodes in the U.S.-Canada Air Corridor. This wasn't a seasonal reduction. It marked a structural realignment in how Canada's largest airline viewed the U.S. market. Lufthansa and Air France also began scaling back. Both carriers reduced capacity, citing lower demand for transatlantic travel to the United States. One central factor driving this retreat is economics, more specifically, rising operating costs fueled by tariffs. In 2025, the Trump administration introduced sweeping tariff hikes: 25% on goods from Canada and Mexico, 20% on Chinese imports, and 10% on goods from other trading partners. For airlines, these measures translated into significantly higher costs for aircraft parts, maintenance supplies, and support equipment, all essential for operating U.S. routes. Everything from landing gear components to navigation systems now came with an added tax burden. These increased expenses forced foreign carriers to reassess the profitability of their U.S. operations. With shrinking margins and growing risk, many concluded that scaling back or exiting entirely made better financial sense. Tariffs weren't the only issue. Passenger demand for U.S. destinations has fallen sharply. A combination of high ticket prices, stricter visa policies, and general economic uncertainty has made the U.S. a less attractive destination for international travelers. Immigration hurdles have grown steeper, and with the U.S. dollar remaining strong against most major currencies, travel to America has become more expensive for foreign visitors. Even carriers with government backing, like Lufthansa, began shifting resources away from U.S. routes to other global regions, showing stronger demand. Air France adopted a similar strategy, redirecting capacity toward European and Asian destinations where economic conditions and consumer demand remain more stable. While major hubs like New York and Los Angeles continue to see international flights, smaller and mid-sized airports are suffering the most. Stewart International Airport in New York serves as a prime example. Once a growing hub for international travel, it lost its final overseas route with the departure of Play Airlines. Its international terminal now sits largely unused. Local businesses that once thrived on international traffic, airport retailers, hotels, taxi companies, and tourism operators are reporting steep declines in revenue. Some hotels near affected airports have seen booking rates fall by nearly half. Retail stores report foot traffic dropping by as much as 50%. The financial losses extend beyond private businesses. City and state tax revenues tied to tourism, travel, and airport activity are taking significant hits. Municipalities that invested heavily in airport expansions and infrastructure upgrades, expecting continued growth in international traffic, are now facing underutilized facilities and budget shortfalls. Unlike previous disruptions in the aviation sector, this retreat is happening without public protests or dramatic announcements. Airlines are simply canceling routes, reallocating aircraft, and pulling back. The skies above America are quietly growing emptier, and the economic consequences are beginning to ripple outward. As international carriers continue to exit U.S., cities are left grappling with an uncomfortable question. Can they reverse this trend? Or is this the start of a long-term decline in America's role within global air travel? As international airlines scale back operations, the fallout is being felt far beyond airport gates. Local economies that rely on international travelers are grappling with sudden revenue losses, shrinking employment, and stalled development projects. Small and mid-sized airports across the U.S. are seeing the most immediate impacts. Stewart International Airport in New York now stands as a stark symbol of the crisis. Once viewed as a promising international gateway, Stewart has lost its final overseas route. Customs halls sit empty, international terminals remain unused, and staff reductions have already begun. Tampa International Airport, once a growing hub for transatlantic flights, faces a similar decline. Multiple gates now sit idle, and airport officials admit it could take years to recover lost passenger volume. Airports in cities like Detroit, Indianapolis, and Minneapolis have also suffered major international service cutbacks. Airlines that once connected these cities to the global network have pulled back, leaving infrastructure investments underutilized and airport revenue streams diminished. The economic impact extends beyond airport property lines. Surrounding businesses built around international traffic are reporting steep declines. In Buffalo, New York, hotel occupancy rates have fallen sharply since early 2025. Restaurants, convenience stores, and tourist shops near the airport bustling with Canadian visitors have seen customer traffic drop by nearly 50%. Local taxi drivers and rideshare operators report a one-third reduction in airport-related trips. Seattle and Detroit tell a similar story. According to local business associations, retail sales in airport-adjacent areas have dropped by over 12% year-over-year. Airport restaurants, duty-free stores, and transportation providers are among the hardest hit. These declines are not limited to travel-related businesses. Reduced international traffic also affects conference centers, event venues, and entertainment providers. Cities that once positioned themselves as international meeting points are struggling to attract global conferences and corporate events. According to the U.S. Travel Association, the country stands to lose an estimated $8.5 billion in tourism-related revenue for 2025. This figure includes lost hotel bookings, airline ticket sales, dining, entertainment, and ground transportation revenue. Cities heavily dependent on international tourism such as Tampa, Buffalo, and Seattle are experiencing the sharpest declines. Some local governments are now reevaluating marketing budgets that were previously aimed at attracting foreign visitors. Tourism boards in these cities had invested heavily in campaigns targeting European vacationers, Canadian shoppers, and international business travelers. Now, many of these initiatives are being paused or scaled back due to reduced demand. The ripple effects extend to municipal budgets. Reduced passenger volumes mean lower airport concession revenues, parking fees, and landing charges. Fewer travelers translate into lower sales tax collections from hotel stays, dining, and retail purchases. Cities that borrowed heavily to fund airport expansions or terminal upgrades are now facing financial strain. Infrastructure designed for growing passenger flows is operating below capacity, with some airports considering staff reductions or delaying further investments. Additionally, job losses are mounting. From airport security personnel to janitorial staff, hundreds of positions tied to international flight operations have been eliminated at affected airports. The psychological impact on these communities is also growing. Many cities had built their identities around being international gateways, with branding that emphasized global connectivity. Losing that status affects not just economics, but civic pride and long-term planning. Unlike temporary disruptions caused by weather events or global crises, this downturn appears structural. Airlines aren't suspending routes with plans to return next season, they're canceling indefinitely and reallocating aircraft to markets, showing stronger demand and lower costs. Decisions are being made quietly, often with little public notice. Airport boards frequently learn of route cancellations only after the fact. There are no major press conferences or diplomatic disputes, just a steady, silent withdrawal. As 2025 progresses, the question becomes clearer. Can U.S. cities dependent on international air traffic pivot quickly enough to avoid deeper economic damage? Or will this emerging crisis continue to spread, reshaping America's aviation map for years to come? While U.S. cities struggle with empty gates and declining passenger numbers, international airlines are making strategic moves that signal a long-term shift in global aviation patterns. The focus is no longer on the American market. Instead, carriers are turning toward regions offering higher demand, lower costs, and fewer policy barriers. Airlines from the Middle East, Europe, and Asia are rapidly reallocating aircraft to destinations across Southeast Asia, Africa, and Latin America. This isn't a temporary adjustment, it's a structural realignment based on profitability and growth potential. Turkish Airlines, once focused on building its transatlantic presence, has scaled back North American routes in favor of expanding services to cities like Jakarta, Mumbai, and São Paulo. These changes reflect shifting trade corridors and emerging middle-class demand across the BRICS nations and beyond. Similarly, major Chinese carriers, including China Southern and China Eastern, have reduced flight frequencies to American cities such as Los Angeles and Chicago. Instead, they've increased service to African, Southeast Asian, and South American destinations like Bangkok, Nairobi, and Lima. This pivot aligns with China's broader economic strategy, including reduced purchases of Boeing aircraft and increased support for domestic aviation manufacturing. Emirates and Qatar Airways are following suit. Both airlines have expanded capacity to cities across Asia and Africa while leaving their U.S. route maps largely unchanged. Industry data from early 2025 shows Emirates adding over 50 new weekly flights in these growth regions, none targeting the United States. Driving much of this shift are the operational hurdles faced by airlines servicing the U.S. Tariffs imposed in 2025 under the Trump administration have raised costs on aviation parts, fuel, and maintenance supplies imported from key partner countries like Canada, China, and Germany. Additionally, stricter U.S. visa policies and growing processing delays have discouraged international travelers. Many foreign passengers now prefer destinations with simpler entry requirements and more affordable travel options. For airlines already grappling with tight margins, the combined effect of these policy changes and declining demand makes U.S. routes financially unappealing. As carriers pull back from American airports, new hubs are rising elsewhere. Singapore and Istanbul are expanding terminal capacity to handle increased international traffic. Dubai and Doha are strengthening their positions as key global transfer points between East and West. Aviation alliances are also shifting. Airlines are restructuring partnerships to favor hubs in Asia and Africa, where passenger growth remains strong and government policies are more business-friendly. Industry analysts predict that Southeast Asia will see a 15% increase in international air traffic by the end of 2025, while Brazil and India continue recording steady inbound traffic growth. For the United States, the implications extend far beyond aviation statistics. Reduced international flight connectivity weakens America's position in global commerce, education, tourism, and diplomacy. Cities like Buffalo, Tampa, and Seattle now face fewer opportunities to host international conferences, attract foreign investment, or draw global tourists. Universities may see declining enrollment from overseas students. Museums, festivals, and business conventions are already reporting lower international participation. Over time, this reduced visibility on the global stage could erode soft power and diminish economic competitiveness. Even for outbound U.S. carriers like Delta and United, the imbalance creates financial strain. Operating outbound international flights without strong inbound demand upsets the economic equilibrium of route planning. The most troubling aspect of this shift is its permanence. Airlines design their route networks years in advance. Aircraft purchases, crew training, and ground infrastructure are all part of long-term strategic plans. Once a market is deprioritized, reversing that decision is neither quick nor easy. Already, Projections suggest that US-bound international flight capacity could fall another 20% by year-end, pushing total tourism-related revenue losses into double-digit billions. If current trends continue, America risks becoming a secondary consideration in global aviation strategy flyover market for carriers focusing on more dynamic regions. Experts argue that reversing this decline will require significant policy changes. Lowering tariffs, streamlining visa processes, and restoring trade partnerships could help make the US market competitive again. However, with airlines already doubling down on emerging markets, time is running short. The longer the US remains uncompetitive, the more entrenched these new global flight patterns will become. For now, America's empty skies stand as both a symptom and a warning. In a world driven by connectivity, being left off the global map comes with lasting consequences.